in the precious metals market. A bit of a delayed reaction. I mean, gold was up a bit yesterday. Silver, of course, up even more. But today, gold rose $50. I think at the high, it was up maybe about $60. Like silver, which at one point today traded north of $64 an ounce. If you are waiting for silver to come down, stop waiting. We are going to be $100 an ounce, I think, next year. This is a direct reaction to what the Fed did.
The Federal Reserve's December 2025 decision to cut rates and resume quantitative easing, QE, under the guise of reserve management purchases is a critical inflationary turning point. Economist Peter Schiff argues this stealth money printing directly monetizes U.S. debt to fund deficits and prop up markets for political reasons, sacrificing the dollar's value. The immediate result: gold surged $50, silver hit a record $64 plus, and mining stocks exploded. Schiff predicts this guarantees a severe cost of living crisis for 2026, with silver targeting $100 and gold $5,000 to $6,000, as the Fed has chosen to prioritize political expediency over price stability. Subscribe to Fine Metals for future updates.
The big story is what I've been saying was going to happen for years. And I'm actually surprised that the Fed was able to hold off this long. And I'm talking about the return to quantitative easing. And in fact, if you recall, at the last FOMC meeting, the Fed indicated that in December, quantitative tightening would come to an end. And what I said at the time was that that was just the first step to pave the way for quantitative easing, that they obviously couldn't do quantitative easing if they were still doing quantitative tightening. So before they can go to quantitative easing, they'd have to end quantitative tightening. So the Fed said, we're going to create more inflation in quantitative easing, right? You've got to read between the lines, although they don't make it that difficult to read between these very, very wide lines. But what Powell announced was that in the next month, the Fed is going to buy $40 billion of Treasury bills. It's now $6.5 trillion. Why do they need more reserves? Clearly, what they're trying to do is avoid admitting that they're doing quantitative easing. Because what is the difference between what the Fed just announced they're going to do and quantitative easing? Nothing, because they are the exact same thing. Powell said that the Federal Reserve is going to create money and then use that new money to buy treasuries. Well, what did they do when they were doing quantitative easing? They created new money and they used that money to buy treasuries. It's the exact same thing. The only difference is when they were officially doing QE, other than admitting it, was that they were buying longer dated maturities. Right? They were going out and buying longer term treasuries. What Powell announced is that the Fed's going to buy short-term treasuries. Okay, but it's still the same thing. A treasury is a treasury. Printing money is printing money. They're creating inflation to monetize government debt. I'm not claiming it's quantitative easing. It is quantitative easing. I don't care what the Fed wants to call it. They can call it whatever they want. In fact, quantitative easing is just inflation. What they care about is a collapse in the stock market, a collapse in the real estate market. Why? Because that's what Donald Trump cares about, right? The Fed is claiming that it's worried about inflation because, after all, it is 3%, right? Even the way the government measures it, they are still erring on the side of making inflation worse, making the affordability crisis worse. Now, the only difference is how far, down the yield curve, right, are they going? But, of course, it's only a matter of time, right? Now that they've restarted quantitative easing, how long before they're going to expand the maturities and start buying longer dated paper? Peter Schiff says prices are still going up. He's wrong. They're going down. Look at gasoline. It's $1.99 in one somewhere. And then he said, and the price of everything else is going way down. The price of nothing is going way down. The price of everything is going up. The price of some things are going way up. So he's saying I'm wrong because I'm saying prices are going up when they're going down. Because I think in 2026, that's going to be when U.S. retail investors really start getting out of some of these tech stocks and getting into value stocks, getting out of crypto, getting out of Bitcoin, getting into gold and silver, getting into the mining stocks. That's a 2026 story. And we had a big move up in the GDX and the GDXJ, both of those indexes finally hitting new 52-week highs. And if you recall, on my last couple of podcasts, what did I say was going to happen? I said that both silver and the GDX and GDXJ would hit new highs before gold hit new highs. And that is exactly what has happened. Because in this leg of the bull market, silver is leading gold, and the miners are leading the metal.
Peter Schiff issues a scathing critique of the Federal Reserve's December 2025 policy shift, declaring the return to quantitative easing an act of economic sabotage that prioritizes political demands over stability. He details how rate cuts and money printing into 3+% inflation will guarantee a soaring cost of living. Schiff also reveals his explosive clash with President Trump, who attacked him on Truth Social for stating this economic truth on Fox News.
I was a big defender of Trump when the media was attacking him when he wasn't president, all the lawfare, all the January 6th stuff. I mean, I defended him in situations. I was a big defender of him with the Access Hollywood stuff during the first campaign. I mean, so I'm not a Trump hater. I mean, I hate some of the things that Trump is doing. In fact, a lot of the things that he's doing now. I think he's doing worse stuff now than he did during his first term. But who the hell knows what Kamala Harris would be doing? All the inflation that the Fed is going to create is bad for Treasury bonds, right? This easy money policy is a negative. And so I think we're going to start to see more weakness in the Treasury bond market. We didn't see that much, right? So far, the market reaction has been more in the U.S. dollar, which sank to a 2-month low today. You know, the U.S. dollar index now, which had gone back above 100, we're now at 98.33. I think the dollar is very close to a new record low against the Swiss franc. I mean, we may actually be there. I didn't, check the prices, but we're back below 80 cents on the dollar Swiss. In fact, right now it is at 0.7949, so below 79.5. I don't think it's ever gone below 79. Right? So I forget if this is a record low, but it's very close. At the same time, they say that inflation is the problem, right? We're worried about inflation. There's risks to both sides of our mandate. And in fact, the decision was not unanimous. There was 3 dissenters, which is the most, I think, since the 80s or something. 2 of the FOMC members didn't want to cut at all. And then Trump's guy, Stephen Moran, he wanted 50 basis points. He didn't think 25 basis points was enough. Of course, neither did President Trump. He wants bigger cuts. The Fed will be a buyer of Treasury bills. There's no specific commitment. We don't know exactly how many they're going to buy, but they're going to be buying them. And Powell said, hey, the only reason we're doing this is because we want to maintain ample reserves over time. Well, first of all, we got a $6.5 trillion balance sheet right now, and then some, right? So quantitative tightening is over, and the Fed has $6.5 trillion. Isn't that ample? I mean, that's more than ample. Remember, before the 2008 financial crisis, they didn't even have $1 trillion. And then at the end of the official QE programs before COVID, the balance sheet peaked at $4 trillion. To make sure we have price stability, which they've redefined as 2% inflation. But they said, if we have this low inflation, that's the environment that's conducive to strong employment. So if you have a situation where you're not sure, which is what the Fed admitted, that we really don't know, right? And Powell kept saying that is a unique problem that we have now, because normally it's clear, it's one or the other. And he said it's not clear. We're not really sure, what we should worry about more, inflation or labor. Based on what prior Fed chairman and Powell have said, the more important of the two is inflation. I don't believe it's going to take very long because the yield on the 10-year Treasury is 4.15%. It did not go down when the Fed cut. It seems to be holding a bit steady, and it's not getting below 4%. Mortgage rates are not going down. This rate cut will have zero impact on mortgage rates, right? But everybody wants mortgage rates to go down, at least in the administration, right? That's what the goal is. But they're not getting that. But as I have also been predicting, these rate cuts are bearish for bonds. And in fact, if you know that the Fed is only buying Treasury bills, why do you want to own a Treasury bond? The Fed's not buying that, at least not yet. I mean, somehow the Fed thinks if they can stimulate spending, right, with lower interest rates so we can borrow more money and spend it, that somehow that extra borrowing and spending is going to lead to job gains. It doesn't. The only way inflation increases employment is by reducing the minimum wage. That's it. Inflation lowers wages. And so, yes, if you lower wages, you'll increase the demand for workers. So in that respect, yes, inflation can help employment, but that's not what people want. And that's not what he's claiming. He's not saying, well, we're going to reduce the value of everybody's wages so that people get jobs. And of course, a lot of people demand wages, raises rather. But obviously the minimum wage, it's a way to reduce the minimum wage. And went back to quantitative easing. Powell kept reassuring the reporters, we're going to get to 2%. We're going to deliver 2%. Okay, but what are you doing? How are you going to do that when inflation is 3% and you're cutting rates and you're printing money? You are interjecting monetary stimulus into an economy when inflation is already too hot and moving in the wrong direction. Right? So how are they confident that inflation is going to go down to 2%? They should have zero confidence that that's going to happen. I mean, what they do is they look at the long-term bond market and they look at the tip spread and they think, well, you see, if the markets were concerned about higher inflation, we would see it. But, we're not seeing that in the bond market yet because the bond market isn't necessarily showing it yet. The bond market is still reacting to weakness in the economy. They're probably reacting to the anticipation that the Fed will start buying the long bond. But a lot of these traders still don't get it. They still don't understand that a weak economy is actually bad for bonds because it means bigger budget deficits and more inflation. We forecast 2% because that's our goal. And we just assume that we'll achieve our goal. And so if we're not at 2%, our forecast is always 2% in 2 years. And so the whole target isn't actually like a forecast where they're trying to figure out where inflation is going to be. It's more like just a wishful guess, right? Since they want 2% inflation and their policies are geared supposedly to give us 2% inflation and they have confidence in themselves, they base their forecast on that. So they say, well, we want inflation to be 2%, and so our forecast is that in 2 years it will be 2%. But it's not based on any actual economic statistics or reality that would suggest it's going to be 2%. And so whenever it's above 2%, their forecast is always going to be that it will be 2%. I mean, maybe if it's 10%, they're going to say, well, it's going to be 2%. That, they don't care, right? So that didn't even come up. But the fact that Powell acknowledged multiple times that they're really unsure, and then at the same time telling everybody we will get to 2%. It's going to happen. We're going to bring it there. How? If that were the case, you would prioritize it. You would say, you know what? The labor market is weakening, but we still have low unemployment. The key is inflation is still well above our target. And so we've got to hike interest rates. The fact that the Fed is willing to cut rates when it's a close call, and the labor market, according to them, is not really weak. It's just weakening. It's just at risk that unemployment might go up. But the bigger risk is that inflation might go up, right? Any central banker, right, worth his salt would perceive the inflation risk as the greater. But again, inflation, the prices are rising a lot faster than the government admits and that the Fed admits. The Fed is still basing everything off the CPI or the PCE without acknowledging that these numbers are too low, right, by design. Yet the Fed, despite the fact that the government numbers are still showing 3% inflation, that probably means 6% inflation, the Fed's cutting rates. The Fed is returning to quantitative easing. Again, part of that is to try to prop up the housing market. Housing prices are poised for a big drop, right? Because nobody can afford to buy the houses. And if nobody can afford to buy a house, that means nobody can sell a house because you can't sell unless there's a buyer, right? Now, if you don't have to sell, okay, then prices can stay up. But as people who own homes have to sell them for whatever reason, they get divorced, they move, they die, they lose a job. There are things that happen, right, that cause people to have to sell a house. And they can only sell it to somebody who's able to buy. And if the pool of buyers isn't there because prices are too high relative to what it's going to cost them to take out a mortgage, the prices are going to go down. If your bar says it's 1 kilo, even if you have a little bit of another metal, you've got to have the kilo of gold because you can melt it down and separate the gold from the other metal and get all the gold. So, but I don't know, right? I'm just looking at this bar gold, and I have no idea how much gold is in there. I mean, I know there's got to be some gold in there, but is it a real kilo bar? Does it really have all this gold? And I said, well, I don't know. Is it real or is it? I don't know, right? And they use that to say, aha, you see, Bitcoin is better than gold. Because Peter Schiff, with his naked eye, if you give him, a kilo bar of gold, he doesn't immediately know if it's real or not. Well, when would anybody even be in those circumstances? Do you think when we were on the gold standard and people walked around with huge bars of gold, and if they wanted to buy something, they said, here? No, they used coins. The coins were minted by the government. And if you counterfeited them, it was the death penalty. But they were 1 ounce coins. Everyone knew what they looked like. If somebody gave you one, you can compare it to one that you already had, right? You look at it, make sure that the edges are not been smoothed down, because if somebody smoothed down the edge, it means there's not all the gold. So you make sure the mill marks are not messed with, and people would, drop it on a table and listen to the sound because they know the sound it's supposed to make because they have other ones, right? So if you're dealing with actual coins, right, that were made for transactions, it's very easy to recognize a legitimate coin.